Questions about the private credit. Guess what? When you have your money on the bank account, you hardly get any. Your friend asks you to borrow $100. The interest was way higher than Hello from the home office this morning. So I have had quite a few questions about the private credit and if it's a valid strategy and what does it entail, what does it mean, and what kind of returns can it get you. So think about the credit this way. So if you borrow from a bank, for example, you have a credit card balance or you have a line of credit or you have a mortgage, you borrow from the bank. And for using this money, you are paying interest to the bank or credit card issuer, which often enough a fairly big amount. Guess what? When you have your money on the bank account, you hardly get any interest. As you know, checking accounts are pretty low, with some exceptions that I actually have in the description of this video, or well, Simple is one of the companies I like working with. But generally speaking, the bank does charge you for using the money. They don't actually pay you much for using your money, but they charge you for using theirs. On the other hand, let's say you have an extra $100, your friend asks you to borrow $100, you lend the money to somebody. Chances are you're not charging your friend to use the $100, I don't know. But typically it's hard to set up, and there's obviously always a risk of not even being able to collect your money back. So when I came to Canada and I wasn't able to obtain the mortgage I wanted for the full amount or 95% amount of the first apartment I had to purchase, I was stuck with having to find additional 15% of the value of the apartment to come up with a higher down payment to be able to buy the apartment I had my eyes on. And because I did not have the funds, I had to go into second mortgage. So, and this was my first exposure to private mortgage here in Canada, and I believe in many countries there are some equivalent to that. So you basically borrow money. In my case, that was a couple, I don't even remember the names, doesn't matter. They wrote me a check for that amount, and I was every month repaying them part of that amount and the interest was way higher than what the bank was charging for the mortgage. But because I was stuck, I had to pay that higher interest rate on obviously higher risk lending for that couple, and it was all done through an agency that was doing basically nothing but the second and third mortgages. So fast forward, I started asking questions. How can I possibly invest? Because if I bring my money to the bank, I basically have no return on investment, where I have seen firsthand that a couple investing maybe substantial but not crazy amount. We were not talking hundreds of thousands or even millions. I think the amount was in the $10,000-$15,000 range at that time, but I had to borrow that money and then repay to them, and they made a better return on their money than they would have had with any bank savings account. So in reverse, I was wondering if I could invest some funds into something similar instead of having money on my savings account. After exploring a little bit, yes, you can go through an agency that does second, third mortgages. There is also such thing as private credit that you will see by investment companies, and that is basically lending money to borrowers that either not qualified to work with the bank, or they choose not to work with the bank for whatever reason, and you lend money to businesses or private people to get a higher return on investment that you would otherwise get if you were just putting it on savings account. Yes, there is a risk. There is also a risk of liquidity. So you might be repaid your interest and part of the principal, but you will not necessarily be able to collect the entire amount like you can in a bank. So in a bank, your money is always liquid. You can come in and withdraw all your money if you want to. With private lending, it doesn't work that way. Again, if the couple wanted to collect the whole amount they lended to me, they would not have been able to. I made my payments, but I would not have been able to overnight come up with the entire amount at that time. So there is risk and reward. There is a risk of being paid, risk of being able to collect the principal and or interest, but there is also the reward of higher interest rate. Now, it seems intimidating if you had to deal with it yourself, and you don't have to. Luckily, there is enough agencies, investment companies that would do either on a case-by-case basis, and you say, I have X amount of money that I would potentially invest in second, third mortgages or any other type of private credit, or you can go straight to funds. And those funds are basically operated similar way as mutual funds, that you would be able to put your money in, and then you have fund managers that do this kind of lending. They are vetting the applicants, they are following up, they are managing, screening, filtering, collecting, administering all the background checks, so you don't have to worry about it. There's obviously some management fee, but at the end of the day, typically it does come to a higher return on investment. So my opinion is, as one of the tools for diversifying your portfolio, that might be a good idea, because it's better than cash. You do invest, it is a higher risk. So it would not be my decision ever to make it my only investment. That would be way too risky. But if you decide to put a certain amount, it might be fit in your portfolio. Again, that's my personal opinion. This is not an investment advice, because everyone's decision is very individual, depending on your situation and when you need the money, how much you have available, and so on for investment. It's also the question, if you're a beginner investor, risk and liquidity aspects, it might not be your first choice or your first investment. It is probably more suitable for more advanced and experienced investors, but just that you know that is an option. And some companies, again, like Wealthsimple, for example, Sagard, that Wealthsimple is working with, lots of other investment companies would have it available, but they would not have it available on their front page like you would, say, for example, go to CIBC website and have the list of all accounts, checking, savings, credit cards, and so on. So that's typically buried somewhere a little bit further down, and this is the questions you need to ask. That's why I think it's more suitable for more advanced investors and more diversification. So if you only started investing and you have some mutual funds, some bonds, maybe some GICs, stick to it until you're comfortable, and then you can maybe add private credit or even private equity later, separate topic, to your portfolio of investment once you get more experience and maybe also more funds that you are investing. As a more extended information about it, I am including a few clips from a webinar on private credit from Sagard, which is an investment company that manages one of those funds. And one of the fund managers is specifically talking about the pros and cons of such investment and the performance of these private credit portfolios over the years. Again, if you're not at that stage yet, it's still for your information and future ideas into what you might want to invest down the road. And in the meantime, if you want a good return, or at least what I believe the best you can on your checking account these days, is click on Wealthsimple account link opening below, and you'll get a bonus $25 on your account. It's a win-win. So good luck with your investments.
Yeah, and so I think there are a few important things on the funds, like the floating rate feature I talked about. Private credit isn't a liquid asset class, but we do invest in some liquid securities so that our clients, if they need it, we can offer expected quarterly liquidity. It's not guaranteed, but it's something that we put a lot of thought into being able to offer and make sure we're managing risk appropriately to do so. It's denominated in CAD, so you don't take foreign currency risk, but you can invest in opportunities throughout North America. I think that's essential, right? We do invest in Canada. We like investing in Canada, but the United States is another very good market to invest in. So having that scope is really useful while you're eliminating the FX risk. And then finally, co-investing with institutional investors. I think this is really an institutional investing product that we're offering to individual investors. When we looked out of the market, when we were sort of looking at where do we invest our clients in private credit, we thought that investing with the best investors, investing in institutional quality strategy was really important, particularly as you get tested in the market cycle.
So maybe Ben, taking a step back from the fund specific to private credit as an asset class, maybe just speak about the emergence of this, just the asset class, basically since 2008.
Yeah, I think this is a really interesting trend, and it's been more and more attractive to investors. And one of the main reasons why it's emerging is mostly structural. After 2008, there were changes in bank regulations that made banks pull back from lending. And the reason for doing that is to reduce systemic risk in the overall system. That's what the regulators are trying to optimize for. And that is because banks are, in a bank, you're borrowing money from clients, from your customers, but you have daily liquidity, and then you're lending it over a longer time period, and that structural mismatch then creates a risk in the financial system, and then people can lose their deposits if loans to corporations are systematically going bad, and that's one of the reasons why banking is such a highly regulated industry. Regulators took a look and said, maybe we should reduce some of the lending on these banks' balance sheets. Companies still needed access to the credit, but then there's a pool of investors who are going to say, I actually do have a longer time horizon. I want to take the credit risk. And then it's been a really nice solution for companies to have it in a way that does manage some of the systematic risks that bank lending provide. You combine that with some of the structural features that we've been talking about of managing risk as well as attractive overall returns, it becomes a very nice asset class, and then one that we think still has a lot of runway. There's been tremendous growth. But as clients see the benefit and as borrowers see the benefit of private credit, and the banks are still seeing their balance sheets constrained, we see room for this to continue to grow. And then this is more for me as an asset allocator. Why do I like private credit? On the far left side, you can see the returns since 2004. This is just index returns, not our fund. We expect it to differ in material ways, but just to give you an understanding of why I said, hey, let's get our clients into this asset class, and then representing what many clients might have elsewhere in their portfolio, so U.S. stocks and U.S. government bonds, and then you can see the returns for each year. That's what each column is, and then what you want to see is you're going to see hopefully high but volatile returns from stocks. You're going to see government bonds hopefully diversifying in times when stocks are performing well. And then in private credit, you want something because it's risky credit, you want to see it performing well in boom times, but not quite as well as stocks. But then when there are periods where stocks pull back, you want to see private credit outperforming. So for instance, in 2015, interest rates went up in a surprising way that depressed stock market returns and depressed bond returns. Private credit came through in that time. Same story with 2018, same story with 2022. This is the kind of thing that can happen periodically. Whereas in 2008, you see, there's a big recession unanticipated by the market. You see really strong returns from government bonds. Private credit took a loss, but you see the risk management come through in that year where the loss wasn't severe. And then a negative 40 in the U.S. stock market. And actually the peak to trough drawdown was worse than that. You already started to see the peak to trough drawdown in the financial crisis was worse than what's on the page here, just because of the calendar year timing. So this is what I'm trying to get in a portfolio. I like private credit because you get overall, good returns, right? And the returns of the U.S. stock market have been at the higher end of what you can reasonably expect over 20 years. But you get competitive returns from private credit, and you get it coming through when you want it, alongside with downside protection. And that's really what's motivating this and the role it has in our client portfolios.
If you're not ready for private credit investments yet, I hope this video was at least giving you some ideas for down the road and was educational and helped you to plan for the future. In the meantime, if you want to get the best return on investment you can get today on your regular checking account, click the link below. Wealthsimple is giving you $25 if you follow that link to open your first Wealthsimple account, and happy investments.